Good morning, dear students. Today we are going to learn what is journal entry. Transactions. A business transaction is anything that an exchange of value happens with the normal operations of a business. Every transaction must be recorded. Every transaction affects at least two accounts. Up to now, we have been using T accounts or T-shaped accounts where debit equals to credit. Transaction example. We will take an example. The owners invested 20,000 into their business. So how we will record in transactions that cash equals to 20,000 on the debit side and another side of the T account capital is credit side 20,000. The things that are changed, the concept of T account remains debit equals to credit. At least two accounts are affected, but rather than entering the transactions into T-shaped account, immediately we will use journal. What is journal? Personal daily diary. The textbook says the journal record of all the parts of the transactions in one place. The date, the debit, the credit, and the explanation of each transactions are recorded together, can recorded mutually or manually or electronically. Journal. The account loves to get his or her thoughts and feelings, transactions into his or her journal as soon as something happens with the business. What are the advantages of journal entries? The complete transaction is recorded in one place, reduce errors, easy to make mistakes in T-shaped account, debit but no credit and only one account, etc. The transactions are listed in chronological order, show a picture of every day at a business. What is accounting cycle? This unit is also all about the different steps of accounting cycle. The accounting cycle is the process an account goes through during a financial period or a physical period, beginning with the business transaction, ends with the preparation of financial statement and closing entries. This is the general cycle of the accounting, or we can say this is an accounting cycle. What is accounting cycle? Once a transaction occurs, journal entry, then ledger, then trial balance, then adjustment entries, then final statement, and then the closure entries. If we see how the journal look like, this is a performer of the journal entries: date, particulars, ledger folio, debit column, and credit column. Journal entries has a 4 steps: record the date, record the account debit and its amount, record the account credit and its amount, and record the explanation or the details, which is in accounting terms known as narration. We can explain it little bit further. The summarization summarize each transaction with the word and as short as possible. Owners invested cash, made cash sale of tickets, brought equipment on account. This is a must of each and every transaction. Refreshing the debit and credit, increase in the amount. Assets, if we post it on the debit side, assets increase, drawings increase, and expenses increase. And as well as the liability side, credit side, liability, owner's equity, and revenue. If decreases side, if the things is decreases, if we post it on the debit side, liability, owner's capital, and revenue. And if the things are reduces on the credit side, like assets, drawings, and expenses. Another tool, assets increases, we will post on the debit side, and assets decreases, we will post on the credit side. Liability increases, we will post on the credit side, and liability decreases, we will post on the debit side. Owner's equity decreases, we will post on the debit side, and if increases, it will post on the credit side. Drawings increases, we will post on the debit side, and if decreases, we will post on the credit side. Revenue decreases, we will post on the debit side, and if it is increases, we will post on the credit side. Expenses increases, we will post on the debit side, and if decreases, we will post on the credit side. That's all for today. Thank you.